Alrighty, our next guest is expecting a second consecutive quarter of earnings gains and says the stock market needs growing corporate earnings to do the heavy lifting this year. Let's bring in Mark Luschini, Chief Investment Strategist at Janney Montgomery Scott. Mark, welcome. Good to have you with us. Let's pick up where Leslie left off, and that was in a discussion of the banks, particularly the big banks. How do you look at their earnings reports and analyze them, and do you think that banks, and maybe especially the big money center banks, are a target of opportunity this year, something they weren't last year?
Yeah, Tyler. I think you see a little bit of a dichotomy between what we saw reported on Friday by the big money center banks and that which Leslie was just reporting on with regard to kind of the investment banks, just because of the composition of their portfolios overall. But turning back to the money center banks, I read it to be somewhat encouraging. Now, obviously, so much is going to depend on the evolution of the economy as to whether we see any uptick in loan demand, which remains relatively subdued at this juncture. But clearly, the money center banks benefited from continued impressive numbers coming out on their net interest margins as a consequence of the deposit flows that went into the money center banks after the banking aftermath in March of last year. And obviously, still quite healthy spreads over that which they are lending money out at. And so as a consequence, I like them from the standpoint of them being great global franchises with healthy dividend yields and maybe yields that can continue to go up. But in the meantime, I'm less than favorable toward them overall, just given the fact that I think economic conditions are going to remain rather docile here in the United States, at least for the foreseeable future, with a non-trivial risk that we do dip into a mild recession perhaps in the second half of this year.
Last year, it seems to me, was the year of two things. One was the Magnificent Seven and their outperformance as a group. Number two was multiple expansion, the speculative premium that people are willing to pay for a share of stock. This year, you think it's going to be driven by earnings, and you think the earnings are going to come from the likes of industrials because of infrastructure spending, industrials like which?
Well, to name a name, healthcare is a sector we also like, but Caterpillar in the industrial sector. Obviously, an iconic company that is a real bellwether on global infrastructure and industrial activity. Not that we expect a big reacceleration of global economic growth for the foreseeable future, but nonetheless, there's obviously a pretty significant impulse permeating the U.S. economy by way of the infrastructure spending on the IRA as well as the CHIPS Act. And even fiscally being underpinned in Europe for many of the same reasons, decarbonization, electrification, and so on, I think is a secular theme that is going to benefit the build out of onshoring, reshoring, and activity around energy transition to clean energy that is going to be a tailwind to Caterpillar for likely some time to come. So an opportunity to pick up a great industrial brand at a relatively inexpensive mid-teens kind of multiple vis-a-vis its counterparts in both the industrial space and the market overall. But I do think earnings are going to have to do the heavy lifting because at 19 and change forward on 2024 earnings, the multiple expansion story of 2023 may be a little more elusive in 2024.
All right, Mark, we have to leave it there. Thank you very much, Mark Luschini. We appreciate it.